Hello friends, good evening. It's Friday, the 17th of October 2025, and you're watching the US Stock GPS channel. After yesterday's sharp sell-off in the financial sector, US stocks rebounded today. The Dow Jones gained about 0.5%, the S&P 500 edged higher, and the Nasdaq also rose slightly. Small caps, however, finished lower. Despite the rebound, the advance was weak. Declining stocks, 3,020. Outnumbered advancers, 2,364. And more stocks hit 52-week lows than new highs, showing a slightly bearish market tone. Let's look at the main drivers. Today's drop in gold, several key earnings reports, and the overall market risk. Earnings highlights. American Express, AXP, delivered a strong Q3 2025 report. Diluted EPS, $4.14 plus 19% YoY, beating $3.99 estimate. Revenue, $18.4 billion plus 11%. YoY, topping $18.05 billion forecast. Full-year EPS guidance raised to $15.20, $15.50, and revenue growth to 9%, 10%, reaffirming its long-term double-digit EPS target. CEO Stephen Squeri highlighted stable spending by affluent customers and healthy credit quality, expressing optimism for Q4. AXP shares surged 7.3% on heavy volume after the release. Other banks, Truist Financial and Regions Financial, also beat expectations, lifting sentiment across the financial sector. Economic data. Philadelphia Fed Manufacturing Index, Oct 2025, plunged to negative 12.8, far below September's plus 23.2, and signaling a sharp slowdown in factory activity, the weakest in 6 months. New orders rose 12.4 to 18.2, but shipments collapsed 26.1 to 6. Employment softened slightly, but stayed positive, while price indexes for both inputs and outputs increased, suggesting inflation pressures remain. Encouragingly, the 6-month ahead expectations index jumped to 36.2, showing businesses still expect improvement ahead. NAHB, Wells Fargo Housing Market Index, rose to 37 from 32, the highest in 6 months, still below the neutral 50 level, but showing improving confidence among U.S. home builders, helped by lower mortgage rates and better sales expectations. However, 38% of builders reported price cuts averaging 6%, reflecting ongoing challenges, macro and sector trends. President Trump's softer tone on China, confirming an end-of-October meeting with President Xi, helped ease trade war fears after last week's tariff-driven sell-off. UBS upgraded global equities to attractive, citing sustainable bull market conditions, though the VIX Volatility Index rose 4% on lingering uncertainty. Energy stocks fell on weaker oil prices, while utilities gained as defensive plays. Commodities, gold and silver. The materials sector was the day's weakest performer, dragged down by gold, silver, and mining stocks. Gold fell 0.85% to $4,267.90 Oz, pulling back after hitting record highs above $4,300. Silver also retreated from multi-year peaks above $54. This drop was driven mainly by profit-taking, technical pullback, a firmer US dollar, and easing safe haven demand after Trump's remarks. Since gold and silver are priced in USD, a stronger dollar makes them costlier for foreign buyers, reducing demand. As precious metal prices fell, miner stocks, GDX, NEM, AEM, AG, tumbled even more due to leverage and cost sensitivity. Should investors worry about their gold and mining positions? Not really. Today's drop looks technical and sentiment-driven, not a break in the long-term bull case. Real yields remain low. Central banks, especially in Asia and emerging markets, keep buying gold. High global debt and deficits continue to favor hard assets. The rare earth trade war noise hasn't truly eased, so safe haven demand persists. At $3,900, $4,000 gold, miners' cash flows stay strong. Historically, such corrections have been buy-the-dip opportunities once volume stabilizes. Still, if your positions are heavy, trimming 10%, 20% in silver or miners is reasonable. Stock focus. Oracle, ORC. Oracle shares tumbled over 7%, one of the biggest S&P 500 decliners. The drop followed its analyst day on Oct 16, where investors reacted cautiously despite bold long-term goals. Oracle projected FY 2030 revenue $225 billion and EPS $21. But near-term FY 2027 EPS targets were below some street estimates. Analysts cited heavy AI cloud infrastructure capex as a short-term drag on profit. Investors also wanted clearer spending details. After a 75% rally YTD, many took profits, adding to the pullback. Market outlook. S&P 500. After a long rally, the S&P 500 looks technically overextended, facing short-term consolidation pressure. Earnings momentum is slowing versus Q2, and external risks, trade tensions, regional bank stress, softer growth remain. S&P Global expects modest Q4 GDP growth, while Morgan Stanley warns of an 11% pullback if tensions don't ease. Though the VIX has eased slightly, it's still above 20, showing fragile sentiment. Still, fundamentals are not broken. To 80% of reporting S&P companies have beaten estimates, and structural themes, AI, capex growth, productivity, continue to support the market. A 5%, 10% correction or sideways phase in coming weeks looks likely, unless a new catalyst emerges. No crash scenario for now, just digestion. Personally, I'd trim a bit from high beta or overextended growth names, keep core holdings, and hold cash for better entry points after a healthy pullback. Looking ahead. The short-term direction for the S&P 500 and Russell 2000 will hinge on Q3 earnings season quality, especially whether big tech can keep delivering strong results and upbeat guidance to justify high valuations. The next FOMC meeting and any surprise on rate cut guidance will be critical, particularly for rate-sensitive small caps. Upcoming inflation and jobs data, plus evolving geopolitical tensions, will continue shaping overall risk appetite. Thanks for watching. If this video helped you understand today's market better, please like, subscribe, and share. See you next time.